A financial plan is a detailed picture of your current finances, financial goals, and any strategies you've devised to achieve those goals. Good financial planning should include details about your cash flow, savings, debt, investments, insurance, and any other aspects of your financial life. If you want to know more about financial planning, please keep on watching. Hello, this is Financial Synergy, and welcome back to the channel. If you are new here, please make sure to subscribe to the channel and turn on the notifications to be notified of every upload. Taking a strategic approach to managing your finances is a good way to stay on track, but even the most organized person doesn't always take the time to create an annual financial plan. As the fall season approaches and students return to school for the new year, now is an excellent time to start planning your financial goals for the coming year. Even if you've been fairly confident in your financial management in the past, understanding how to use an annual financial plan to your advantage can help you make better financial decisions in the future. What is the definition of an annual financial plan? An annual financial plan is a sort of guidebook that tells you where you are financially right now, what your goals are for the future, and what areas or issues need to be addressed to meet those goals. The plan addresses every aspect of your financial life, from investing to taxes to your retirement prospects. While the starting point for developing your plan will differ depending on your age, income, debts, and assets, the most important components of an annual financial plan will remain the same. So, if you're not sure what's included, here are some things to consider. Life occasions. Certain life events, such as getting married or having a child, are obvious reasons to restructure your financial plan. For example, if you have younger children, you should consider how college savings fit into the picture. When your children reach adolescence, paying for college should be at the top of their priority list. On the other hand, a 20-something who is recently married may be more concerned with saving for a down payment on a first home. Looking at where you are in the context of any major life changes that have occurred or are in the works over the last year should influence your planning. Another obvious life change is the impending retirement. Investing and retirement. Saving for retirement should be a top priority at any age, but it is far too frequently pushed to the back burner. According to a Northwestern Mutual survey released this year, 21% of Americans have no retirement savings. Of course, those statistics also show that more than 2/3 of Americans save. On the other hand, saving is not a financial plan, it is merely the raw material for one. Your financial plan should examine your retirement savings options and determine how best to use them. For example, if you have access to a 401k, consider whether you are contributing at the appropriate level. If you can't contribute to an employer-sponsored retirement account, you should consider contributing to a traditional IRA or a Roth IRA. If you already have one of these, the question is whether you are of the appropriate type. Inventory which types of accounts you have, what their balances are, and how all of your investments are doing each year. This includes any retirement accounts, as well as any other investment accounts you may have. Aside from where your money is being invested for retirement and how much you're saving, you should also consider how your assets are allocated and what fees you're paying for those investments. According to a Center for American Progress study, high fees can drain more than $400,000 from a high-income worker's 401k throughout a lifetime. So it's critical to be aware of what you're paying. It may be time to sell your expensive mutual funds and replace them with something that allows you to keep more of your money. In addition, determine whether you are in need to rebalance your portfolio if your asset allocation has veered off course. If you have investments in a taxable account, you must also consider taxes. If you sold any securities for a profit in the previous year, you must be prepared to pay capital gains tax when you file for tax return in April. Harvesting those losses by selling off holdings that have been declining can be an effective way to offset the impact of the gains, but you must act before the end of the year. Finally, you should consider creating additional income streams for retirement in addition to tax-advantaged and taxable investment accounts. Could, for example, purchasing a rental property fit in your plans? Is it possible to supplement your income by starting a side business or investing in someone else's business? If you're worried about not saving enough for your retirement, you should start looking for ways to maximize your income now. Putting money aside for emergencies. While saving for retirement is important for financial planning, don't forget about your other savings goals. According to another Federal Reserve survey, 46% of Americans struggle to come up with $400 in an emergency. So if you don't have an emergency savings cushion, or if yours isn't as large as you'd like it to be, starting one or beefing it up should be on your financial to-do list going forward. Savings objectives for the coming year. An annual financial plan consists of your past and present, but it should also consider your future goals. You should be able to identify what you want to accomplish in the next 12 months regarding what you want to save and where you should put that money by this point. Starting with the total amount you want to save and then breaking it down monthly or weekly can help you work toward your goal more easily. This is also a good time to consider where you save your money in your current life to help you save for the future. Hey there, pal! We hope you're enjoying this video so far. Before we talk about how to start in financial planning, please make sure to give this video a thumbs up and feel free to share your thoughts in the comments down below. Here are the 7 tips to financial planning. Number 1. Begin by establishing financial objectives. Your financial goals will guide a good financial plan. It will feel more intentional when you can approach your financial planning from the standpoint of what your money can do for you, whether that's buying a house or allowing you to retire early. Make your financial objectives motivating. You begin with goals because they will motivate you to take the next steps and serve as a beacon of light as you work to make those dreams a reality. Number 2. Keep track of your money and redirect it toward your objectives. Determine your monthly cash flow, what comes in and what goes out. An accurate picture is essential for developing a financial plan as it can reveal opportunities to direct more money towards savings or debt repayment. Knowing where your money is going can help you make short-term, mid-term, and long-term plans. A typical immediate plan is to create a budget. Ned Wallet recommends the 50-30-20 budget principles. Put 50% of your take-home pay toward needs, 30% towards wants, and 20% towards savings and debt repayment. Reducing credit cards or other high-interest debt is a common medium-term strategy, and retirement planning is a common long-term strategy. Number 3. Obtain your employer's match. When you meet a financial advisor, he or she will ask you if you have an employer-sponsored retirement plan, such as a 401k, and if your employer matches any portion of your contribution. True, 401k contributions reduce your take-home pay now, but it's worth it to contribute enough to get the full matching amount because it's free money. Number 4. Make certain that emergencies do not turn into disasters. Putting money aside for emergency expenses is the foundation of any financial plan. Building credit is another way to protect your budget from unexpected expenses. When you have good credit, you have options, such as getting a good interest rate on a car loan. It can also help you save money by getting you lower insurance rates and allowing you to skip utility deposits. Number 5. Deal with high-interest debt. Paying down toxic high-interest debt such as credit card balances, payday loans, title loans, and rent-to-own payments is an essential step in any financial plan. Some of these have such high interest rates that you end up repaying 2 or 3 times what you borrowed. If you have revolving debt, a debt consolidation loan or debt management plan may help you combine several expenses into one monthly bill with a lower interest rate. Number 6. Invest to increase your savings. Investing appears to be something for wealthy people or those who are well established in their careers and families. It isn't. Investing can be as easy as putting money in a 401k and as simple as opening a brokerage account. Unfortunately, many have no minimum to get started. Create a moat to protect and grow your financial assets. You're constructing a moat to protect yourself and your family from financial setbacks with each of these steps. Continue to create a financial moat as your career progresses by increasing contributions to your retirement accounts, using insurance to protect your financial stability in the event of a car accident or illness. Life insurance protects those who rely on your income. Term life insurance, with terms ranging from 10 to 30 years, is a great fit for most people's needs. That's it for today's video. Please make sure to subscribe to the channel and turn on notifications for every upload. This is Financial Synergy, and we will see you in our next video.